Delighted of Nick Sandler from Stonebriar, Joe Katerina from Global Jet Capital. Joe deserves a special marks for coming here since he only found out he was doing this panel yesterday. And with this in mind, we'll go for the nasty questions first.
Is 39 minutes going to be enough time?
I think it will be enough.
Okay.
Okay, nice easy question for you first, Nick. Take us through securitization in easy terms.
All right, any questions? So securitization is effectively a structured debt instrument that allows for broader investor participation. So the best example I could say is you could go out and get a term loan and negotiate with a single investor. And that investor has certain risks and return objectives. By tapping securitization, you can actually structure that loan into different pieces and create different attachment points for a different set of investors. So you can have someone who needs more higher rated investments at lower advance rates, at lower coupons, and also appeal to those investors that are willing to take more risk and for a greater rate of return. And when you package that all together, you get to sort of a blended advance rate, a blended coupon that's acceptable to you. So it's essentially, in the end, it's an instrument that can create more liquidity in the asset class. It also is advantageous because it's typically in a limited recourse or non-recourse structure where you're putting assets into a pool and not recourse back to the parent. But that's effectively what securitization is.
I think that was very clear. So, Joe, take us through the sort of people who buy secured, asset-backed securities.
Sure. So perhaps it's beneficial if I step back and mention that it was a real challenge taking the investor base through this particular asset class because, prior to us going to market, I think the last pure corporate aircraft ABS that was done was back in 2005 sometime. And then, of course, the Great Recession came, and it just ran off. So there was, a lack of understanding of what our asset was, and we just had a tremendous challenge getting the investor base up to speed as to what we were, including even the rating agencies.
But going back to Nick's talked about packaging. You're basically, rather than selling a loan, you're selling bonds to the market. What sort of people are buying, or what sort of institutions buy assets? Is it life insurance companies, pension companies, banks?
Yes, all three.
Hedge funds?
Yeah.
Largely US market?
For dollar-denominated deals, yes. I mean, I think when you think about the investor base, you've got life companies, large asset management companies that have investment-grade mandates are some of the biggest buyers of securitizations. Hedge funds step into the space in the more subordinated tranches of sort of your B, C, D, sometimes even an E class of your notes that are going to be more yieldy and higher risk. But the overall market is enormous.
So we'll start with Stonebriar. You've issued 4 different deals, which are mixed. You've got a mixture of equipment assets in, but largely business jets, the largest component.
Yep.
And roughly how many investors would you get on a $300 million deal?
So our first deal probably had 12 investors. We have over 30 investors now that are invested in one of the 4 transactions that we've issued since June of 2016. To the point made earlier, definitely most of our time on our deals has been spent talking about business aircraft. It's an asset class that, unfortunately, there's a lot of scars from, and so people want to truly understand residual risk. One advantage of securitization has been, particularly in the more senior tranches, you have a pretty short weighted average life. And so if investors feel like the residual risk is sitting with the more subordinated tranches of the securitization, that makes them more likely to buy. So there are a number of structuring considerations that come into play when you're thinking of assembling a portfolio, but we've probably met with close to 70 individual investors over the last 2.5 years, and happy to say that almost half of them have participated, many of which participated in one or more of these issuances.
Okay, and Joe, you've come with B-Jets twice. You've 2 different B-Jets deals.
Correct.
And similar number of investors for you?
Yeah, so we issued our inaugural ABS issuance in February of 2018. I think for the first one, we met with over 55 potential investors. We closed that transaction with approximately 25 investors. Our second ABS we closed that was about $674 million. The first one was $608 million. We closed that one in June of 2018, again with similar number of investors.
Okay, so I guess I should have started with this question. Why are you guys going through all the effort of going and talking to hundreds of investors when you could syndicate quite a lot of it to people in this room?
Do we have any buyers in this room? Look, I think 2018, in many respects, was a very important year for our asset class because of Global Jet's success in printing 2 very good ABS transactions. Deutsche Bank has served them very well. Bank of America and Credit Suisse have served Stonebriar very well. But I think that neither of us are in this business because we don't expect it to grow. 600 to 700-ish deliveries of new aircraft a year, 3,000 units of transaction volume between new and pre-owned markets. I think demand for the product that we're trying to deliver is going to endure, and us establishing multiple sets of sources of liquidity is going to be very important for the OEMs to hit and the secondary trades to hit those numbers. Because in the end, bank markets have gone up and down, but alternative sources of liquidity are here to stay. And I think that, not to speak for Joe, but I'd say our ability to deliver and to close on transactions is probably the most important component that we can bring to the table to someone evaluating our deal versus maybe a more traditional private bank option. And so if they're going to pay us more for something, we have to give them a reason, and our ability to continue to have liquidity when we need it is paramount to our business model.
So Global Jet Capital did sign a large bank facility when you first started with your private equity backed, so you always needed to leverage. You got a very large facility from a couple of banks, but did you always plan to securitize it later? Was the plan always to go to the capital markets?
Yes. So, typically the acquisition facility, which was combined with a temporary warehouse facility to support future originations in addition to the purchase of the GE portfolio, we always knew that we were going to have to place or arrange more permanent fixed-term financing. And we thought that going into the ABS market would be a challenge, as I'm sure Nick would attest to, but we did that purposely because of the depth and the knowledge and the experience of that investor base. We thought that once they understood our assets, and we're moving from esoteric and alternative into mainstream at some point, and that this will be a place for us to place debt going forward as part of our capital structure.
And Nick, take us through your investors, because I'm not sure everyone in the room understands how Stonebriar is funded, and I know partly that's deliberate. But.
I was going to say, next question. No, we have long-term equity capital. We're partners with a life and annuity company that owns a majority of our equity. So we're not bound by terms. We also, like Global Jet, have a revolving credit facility with some large banks, and also a subordinated facility with a life insurance company that's our equity partner. But those short-term facilities are generally floating rate in nature. They are meant to be termed out with something. It doesn't have to be an ABS transaction. We could look at tapping unsecured markets or even doing secured term loans, but I would say that the upside for us, at least over the last couple of years, of being able to be an ABS issuer has been significant because, again, non-recourse nature of the structures, we get servicing fees on the asset, the customer doesn't doesn't really change anything from the customer-facing point of view. But at the end of the day, we might find ourselves in 6 or 12 months having to look at a more traditional term loan and look at a more covenant-heavy piece of debt to term out our originations if ABS markets seize up. Because one thing we know with history is, one, you can never have enough liquidity sources, and this is one market that definitely seized up for a couple years at the height of the financial crisis, and we can't necessarily assume that, even though we like to say we're a programmatic issuer in the ABS market, if the program's not there, if the market's closed, then we do have to find other alternatives for liquidity.
So for both of you, is it fair to say that, so one way of looking at this is you're tapping the markets now because you can, but you're partly investing now so that you can, in 3 years' time, you can do bigger deals at a cheaper funding rate, depending on what's going on with yield curves and market prices. Is that fair?
Yeah, I mean, I think that, I think right now we've kind of hit our stride on execution, right? I mean, our spreads tightened from 389 blended on the first deal to 190 on our last deal. So I think we've established the asset class as something palatable in the market, and we're 30-ish investors, they're 30-ish investors. Our overlap's not huge. I think there's only about a half a dozen that have bought both deals. So we're talking something close to 60 investors who are participating in the bonds. I mean, that's material liquidity. And there's probably another 15 to 20 out there that got close and either didn't do it because of whatever was going on that week, or didn't get a face-to-face meeting, or whatever they needed to check their box. So, I think right now we've hit our stride, and we're already maximizing execution in this particular class. And I hope 3 years from now we're continuing to tap it, because it's probably the most efficient form of financing we're going to find.
I mean, I would certainly echo what Nick said, in addition to saying that we too did not tap the full investor base for various reasons. One being we had a single rating agency for reasons that we wanted to get to market quickly, but so that shut off some investors insofar as some of them needed S&P or Moody ratings to invest. But we're engaged with them again, and hopefully we'll bring on another one for our next issuance.
So we've got a great question from the audience. How does the relatively short duration for this industry versus other ABS classes impact demand and economics of offerings? So at least one person in the room is following you, which is good.
Yeah, I mean, look, we kind of structure to the demand on some respect, right? So we know that A-class investors probably don't want to see weighted average lives outside of 24 to 30 months in general, and usually even tighter if you're looking at kind of subprime auto or some of the other kind of specialty finance or transportation finance type issuances that are going out there. So we tried to structure something, we try to cater to the buyer, I think is probably the best way to put it. And as far as demand and economics of offerings, I'd say that our A bonds have largely been oversubscribed, and I would say that the addressable market capital availability of those investors is probably approaching $1 trillion. And our subordinated tranches have had varying degrees of popularity, but I think it's all a question of how much. It's a simple supply-demand analysis. There is going to be there's high supply and high demand for the most senior lower risk paper, and as you move down the tranches, your pricing is far more sensitive based on demand.
We closed both transactions with 3 tranches, single A, triple B, double B, with 2, 3, and 5-year ARDs, again, just matching to the appetite of the investor base. And there was, oversubscription at the higher levels, but there is a lot of appetite at the higher yielding lower levels, and we're even thinking of going out with the tranche D next go round if there's appetite for that.
Would you ever sell an equity tranche? Would you ever sell the equity tranche?
I mean, I have no interest in selling any of our equity right now.
No.
And there's also risk retention laws that require a certain level of equity retention. We actually have been the buyers of most of our subordinate tranches because we like the risk profile.
So what's interesting, I think, about securitization is, as we, sadly, we haven't got Ford Von Wisey here today because he's stuck in New York. But his argument for many years, which many people in this room have slept through, is Basel II and changing. Do you see this as something that other institutions will be following in your path as you guys create the asset class?
I'm hoping they do. I mean, again, we put so much effort and emphasis educating this investor base and rating agencies into this asset class. And I think between the two firms here, we have about 1.8 billion issued, and we just hope it continues to grow, and I think it will.
Yeah, it's an interesting situation with you two who do compete occasionally on deals, but in this market, you're both very much reliant on the other one not, if one of you does a bad deal, that impacts the other one, impacts the market. It's not in your interest to badmouth each other like you would normally.
I badmouth everybody out.
Do you lose flexibility? It's another question from the audience. Do you lose flexibility at the deal level if your client asks for modifications, if the deal has been securitized? I'm guessing that's a lawyer question.
Well, look, your servicing agreements, by and large, should cover just about any modification. The only things that would maybe fall outside the normal realm is if there was some significant extension, say, in a term. But that can be addressed through, that can even be structured. So I'd say that, in general, at least our servicing documents allow us a wide berth as far as modifications, and even up to changing registration, for instance, substituting obligors. We can't necessarily step out of certain concentration limits, but I think that, again, we've tried to say what if for a lot of different scenarios to enable us flexibility. Again, if we really want this to be opaque to our customers, which I think is critical, given the high net worth nature of most of our customers, then we never want to get on the phone and be like, actually, we can't help you because we put your transaction to an ABS. And by the way, 47 different investors have actually reviewed the credit write-up with your personal financial statement in it. And it's not necessarily a path that you want to get down. It's disclosed in every deal we do that syndication or securitization is a possibility, and it's done with proper steps taken with confidentiality. But in the end, nobody's really thinking about that, and I think it's our job to make sure that they don't have to.
Yeah, I would just add that we structured it to be as flexible as possible for the issuer, for the servicer to manage the portfolio as they've been historically doing. But the biggest safety valve, I think, on is the fact that we can purchase something out of the ABS to the extent there was an early termination or something like that. So I don't get hung up on any covenant misses or anything like that. I could purchase it out and then maybe even re-lever it under my warehouse.
Another big advantage is that generally securitizations don't have call protection.
Right.
Now, investors may not like you if you prepay your bonds too quickly and do it frequently, but in general, you don't have call protection, which is another big advantage that you would see in a covenanted term loan as an alternative.
I got a great question from Mike Francis. What do your investors like or not like about business jets versus other assets like rail cars, commercial aircraft, ships, etc.?
I think perhaps for Global Jet Capital, it's a little different because, first of all, our owners are a private equity consortium who are expert in this particular space. And then our senior leadership members are all from either the OEMs or somewhere in the private aviation ecosystem. So everybody actually in our group is very high on the asset class.
But I think they're thinking about your bond investors, because when you take a deal to market, you're competing against every other deal out there, aren't you? So it could be auto loans, it could be residential mortgages, it could be rail cars. Do you think, are there any assets is there anything about the asset class of business jets that they like or dislike?
Yeah, I mean, I'd say the number one thing we run into is I can't really sit down and say that this is an essential use asset, right? I can't say if I have a lease to a high net worth individual, there's a bankruptcy, it's not going to go through your normal accept or reject, right? So our approach has been to simply, and it's our approach to investing in general, is to say, look, the asset's the credit. So this isn't about whether or not it's going to default, it's whether or not your servicer is going to be able to effectuate a positive outcome. And so that's where we've probably spent the most time with investors. And look, I'd say I'd bifurcate the ABS market into two sort of types of deals. There are programmatic issuers that have, thousands, if not tens of thousands of obligors and small tickets that effectively an analyst can run through a model. And either there's a green number at the end of the model or a red number. If there's a green, they put it in order. If there's red, they're not. It takes about an hour. Deals like ours with, potentially, just on the aviation side, I think the most we've done is like 24 different individual loans or leases in one of those deals, and call it 60, 70 deals in all. It's going to be a lot of work. They're going to want to spot check credit work. They're going to look at individual deals. They're going to write us for support on residuals. And one of the challenges is if they just have too much going on that week, they might not play in the deal because it's a lot of work to get through. So one of the things that we've done, and I'm sure Global Jet has done, is we spend a lot of time kind of doing non-deal roadshows, visiting the investors, and doing some of that legwork and getting them more comfortable with our underwriting when a deal's not in the market. Because at the end of the day, once it's go time, there's not a ton of time to make a decision. And so I think that's probably the biggest thing is large ticket, rail, airliners, ships, et cetera. These are all have so much history around them, and they have so much diversification in them that it becomes more the function of a model and less of a function of the individual deal. Ours is definitely a function of the individual underlying assets in the securitization.
Because the first commercial aircraft lease deal was in '92, and since then there's been billions of dollars of issuance. Do investors get the difference between? Do a lot of the investors look at your deals as if they're airline deals to start with, and then?
I mean, that's the opening dialogue immediately when we meet with investors, that we are unlike, this space is unlike commercial financing, and we have to take them through that. They already have a preconceived notion that what's the difference between a business jet and a commercial aircraft.
Yeah.
Okay, what's the average loan size been inside? Getting nice questions from the audience. What's the average loan size been inside the securitization? Has there been any correlation to tranches and average loan amount?
I mean, for us, it's probably been, call it $10 to $15 million. The largest deal that we've put through an ABS was probably, I want to say, a little north of $40 million loan. Smallest deal we've done is probably a $3 or $4 million loan. So it's a mix of assets. Again, you kind of see what your pool is going to be, and you structure around it. You don't really, you don't leave a lot to chance there. And if something doesn't fit, typically you leave it out. You don't let an investor kind of provide that feedback.
Yeah. Joe, your deals have been. I was shocked at how varied the portfolio was in the first B-Jets deal. You had some. Small Hawkers, quite old Hawker 400s, and you had a real mix of your portfolio, didn't you? Yeah,
so the first issuance really addressed the GE legacy portfolio, so that had a real good mix of smaller aircraft all on up to large cabin. But for our future issuances, you'll see larger aircraft, bigger ticket, as we underwrite and put new accounts into the ABS.
Question from the audience: what will be the impact of a rising interest rate environment?
Lower returns. No. We've been fortunate in actually keeping our cost of capital relatively flat over the last 2 years, and that's been a function of us being able to achieve a tighter spread, even though rates have been rising, and we expect that to continue in the near term. In the long term, at some point, particularly when we're in a situation where we're both trying to achieve equity rates of return, we may have to pass on that rising rates to our customers in a more meaningful way than we probably have been over the last year. Which is we've done a mix of our rates have been going up, but we've also been able to control our underlying cost of capital to where we haven't had to match it basis point for basis point.
Any old school questions from the audience? It's really hard to look around. Okay, you guys want to encourage other issuers in. You want to make this a big market. The more liquid it is, the less investors will want a sort of intellectual premium for analyzing your deals. Would you honestly tell everyone in the audience whether it is a fun process or not?
Well, I'm not sure we want that many other issuers, right? I mean, I think maybe we want to be able to continue to issue. We know how to do it. We've gone through the process. The rating agencies know us. Yeah. Maybe we don't want, so we've gotten to define the story. I think that the process is interesting. And in many ways, it's a validation of the run-up to the process. So we've both started businesses not that long ago. You've had to kind of go ground up from everything from treasury management to IT to building up a legal department and proposal templates and signature policies and a lot of things that really, most at least operators or owners of business aircraft wouldn't be that excited about. But when we've gotten to this ABS process, it's really become a validation of the hard work that we've put in. And so it's nice to have multiple third parties essentially, believing what we're telling them because we've generated an underwriting thesis, we've executed on a strategy, and this is sort of a validation. So I think from that standpoint, it's actually, I don't know if it's fun, but it's certainly rewarding.
Jay?
No, I would echo that. I mean, the work around the first issuance was harrowing. I mean, you have the rating agencies come in. It's worse than any audit that I went under when I worked at GE. But then, they get to know you after a while. They understand what you're doing and how you're managing things and your underwriting and everything else. And it is validation once.
I still like the use of the word harrowing. Okay, question from the audience. Can you finance companies that have just started through ABS?
Yes.
Okay, and I think we'll go for the last question from the audience. How does the ABS market, and actually we'll come back to that. How does the ABS market accept residual risk on short-term leases?
Well, maybe I'll give a little more of an answer to the last question, which is, if you were going to go into the market and say you want to securitize, say, $250 million of aircraft assets, $75 million could not be from a startup, but $5 to $10 million could. It could impact the rating prospect, but in a sense, between your servicing track record and other assets in the pool, you should be able to kind of get there. The market does not accept short-term residual risk particularly well. I think it's the number one, a question will be, we've been lucky in our leases. We've had kind of an average of 7.5 years, right, of residual date with a weighted average life of less than 2.5 years in the senior bonds. So those investors weren't that focused on it. But I think that if you are going to get into a discussion on residuals, be prepared to talk about your thesis and support it with data. And you know what? These are investment analysts. They do respond to data. They do respond to theses. So don't be afraid of your residual position. Just be prepared to defend it. And in our case, I mean, we tend to compete and buy some of our subordinated tranches, and that also gives a lot of people comfort that we're actually willing to, not only do we own the equity, but we're willing to own a turn before us as well to sort of say, look, we're putting our money where our mouth is.
Yeah, I'd say that, the structure itself with respect to the subordinated tranche and the covenants, residual, the metal value, they shouldn't even get there in terms of a blow up. I mean, there's so much cash flow coming out to them first. And lastly, we do in our structure, we have appraisers take a look at our assets twice a year, and that flows through the waterfall in terms of value. So they're fully and always protected, the investors.
Okay, and final question. Do you foresee more players issuing BizJet ABS deals in 2019?
Yeah, I don't at this point, unless there's some phantom lender out there that's been taking market share from us.
I reckon you might see one next year. I think you might see one new one next year.
Okay. like more operator driven?
And no, I think it could be more financial institution.
Okay, well there you go, guys.
Okay, any more questions? If not,